Okay, mate, I will make this as short and as simple as possible. If you've got any questions, shoot them through. Otherwise, I'm just going to gloss over it fairly quickly. I've built it so that you can come back and review anything anytime. Okay, so options contracts, there's two. There's calls and puts. You can buy calls and you can sell calls. You can buy puts and you can sell puts. Every option strategy is an extension of those two products and those four fundamental positions. Options contracts are always for 100 of the underlying stock. So even if the stock is worth only $1, it's for 100 of them. So $100 worth of stock in total. If it's CBA, for example, they're worth $100 each. So it's still for 100 of the underlying stock that you buy it. So you would be paying 100 times 100. So it's like 10 grand if you bought one of those options. Now that's not the price you'll pay for the actual option. That's just how much money you'd have to cough up if your option was to be worth any money at the end of it. Okay, so key terminology, I won't go through it, but you will need to be across each of these things. Come back to this video again. Assigned is what happens if you sell a put or a call. If you sell one of these things, then you're obligated to provide liquidity. So if you sell somebody the right to buy at a certain price, well, somebody has to sell them that stock at a certain price, and that someone is you. That's the risk you take when you sell somebody one of these things. Selling is inherently more dangerous and risky than buying. If you buy an option, you have the option and you can do with it what you will. But if you sell an option, well, then somebody else has an option and they will do with it what they will, which is inherently more risky. Again, we'll come back to all of these, but these are just terminology that you'll need to be across. So there's two products. If you want to remember it verbally, a call is the right to buy if the price goes up. Okay, just remember it that way. A put is the right to sell if the price goes down. Okay, so if you buy the right to buy if the price goes up, then obviously you want the price to go up. If you sell somebody the right to buy if the price goes up, well, then you want the price to go down. Okay, so you can see how this gets confusing because you can buy rights, you can sell rights, you can buy rights to buy, and you can buy rights to sell, etc. So it can get confusing, but if you just remember that there are two products, calls and puts, and what they are, and you can buy those and you can sell those. Okay, so everything is an extension of these four positions. If you buy something, you expect to pay for it. If you sell something, you expect to receive money for it. Okay, so when you buy an option, you're basically buying yourself the option to purchase something in the future if the price goes your way. Okay, if you sell somebody that option, you get money up front, which is awesome. You can make a lot of money selling people things that will never happen, which is cool because you're getting cash for absolutely nothing. I can sell you the right to buy a house, for example. You say, you can buy my house for $1 million if it ever goes to 1.5. But if it never goes to 1.5, then I'm getting cash for a contract that never is worth anything. The risk in that is it actually does go to 1.5 and I have to sell my house at a $500,000 discount. That's the nature of these things. So that's the fundamentals, man. Read through this if you want. This is the basics. In the next video, I'll just focus on calls. And so we'll get around, just get your head around one product and one position at a time. So one of these at a time. So we'll focus on buying calls first. And then I'll work through them methodically and just examples are your friend here. So we'll just work through 10, 15 examples of each one. Eventually it will sink in.